It's countdown to the monetary policy announcement. Thank you for staying tuned. I'm Chimeze Obi Iwagu. The Central Bank Governor Godwin Emefiele will, in a very short while from now, announce the decisions of the Monetary Policy Committee at today's meeting. In the meantime, here is what the committee did at its last meeting in September. The committee, in a surprise move, voted to cut MPR by 100 basis points to 11.5% from 12.5%, retain the CRR at 27.5%, adjust the asymmetric corridor from plus 200 minus 500 basis points to plus 100 minus 700 basis points around the MPR, and retain the liquidity ratio at 30%. Well, I still have in the studio my discussants here, Dr. Muda Yusuf, the Director General, Lagos Chamber of Commerce and Industry. Thank you very much for sticking on.
Thank you.
And of course, in our Abuja studio, I have Professor Ken Ife there in Abuja studio. Thank you for staying with us here on the show. Thank you. Well, Dr. Yusuf, let me start. Professor was talking about, it's really tight for the monetary policy now on what exactly, to do. And the question a lot of people would ask, looking at the high inflation rate, and of course, central bank is targeting inflation, and then we need the low interest rate. The nexus between interest rate and inflation, can we really achieve low interest rate and low inflation?
Well, I think it is possible. But before I go into that, let me stress the point that, yes, we are celebrating the fact that there is a huge flow of resources now into real economy and all of that. But we have a major challenge with the absorptive capacity of the private sector as far as these resources are concerned. Because if you have the resources, you must be able to deploy them in a way that you'll be able to get good returns. Right now in the private sector, there are major issues or challenges that are being faced as far as investment of these funds are concerned. The first is the liquidity challenge in the foreign exchange market.
Yeah.
Quite a number of investors are stuck with these funds. In fact, some of them are stuck even with the central bank intervention funds. They cannot have access to foreign exchange for their raw materials. They don't have access to foreign exchange to import very vital equipment and all of that. So it's creating a major challenge of uncertainty as far as investors in these areas are concerned. So it is very important that we complement this, the earlier policy that we have commended around monetary policy, interest rates, and the fact that we have seen a switch of resources from investing in financial instruments, government bond treasury bills, into investing in the real economy. But for us to get good value from that, we must complement those policies with appropriate complementary policies in the foreign exchange market. Right now, there's a whole lot of issues around the foreign exchange market. There's a whole lot of uncertainty. Investors are not sure exactly what is happening. They are not getting demand because there's a difference between the rate and the liquidity. It gets to a point sometimes you may not even worry so much about the rate. But you need the foreign exchange to do whatever you can do. If you have the rate, whatever it is, you can work your business model around it and determine whether it's a good strategy to go forward or to go back. But if you are in the dark and you don't even have access at all, I think it's very bad for the investment environment. It's very bad for the economy. So there's a need to review the totality of that. Now, coming back to the issue of the nexus between interest rate and inflation. Now, we can look at it this way. First, the inflation we are dealing with currently are not necessarily driven by monetary factors. They are driven essentially by cost factors. Cost from the point of view, for instance, from energy costs, cost of logistics and transportation, cost of clearing cargoes at the ports, and the exchange rate depreciation. Those are the critical factors driving inflation. And the fact that many of those who are in production don't have access to foreign exchange to produce. So there's a supply side issue. Because they cannot produce, there are shortages, and once there are shortages, prices begin to go up. So this is the context in which we need to address the issue of inflation. I don't believe that cutting MPR or increasing MPR or tinkering with some of these monetary policy instruments can change anything as far as the inflationary situation is concerned. And don't forget, there's also the issue of security, which is affecting food supplies. You know, these are the real issues driving inflation. And my thinking is that if we are able to support the environment, if we're able to address some of these structural issues, if we're able to improve on the foreign exchange management framework, we are likely to see much bigger level of investment. And if we see much bigger level of investment, we are likely to experience bigger output. If you have bigger output, inflation will drop. Because the whole phenomenon of inflation is when you have too much money chasing too few goods. If we're able to deal with the supply side through the right policies, through some of these structural problems that we deal with, I mean, we are likely to have better moderation of inflation.
All right, let's get the view of Professor Ife on this. Professor, I'm sure you're listening to Mr. Yusuf on this, talking about the foreign exchange management for you. How would you assess the management of the foreign exchange so far? Are you happy with that?
Well, the devil is actually in the detail. I think we need to do more on foreign exchange management. There's no doubt about it. But you have to realize that the options are very few. The source is very scanty. If 90% of what we have as forex is coming from oil, then we've got to find other ways of increasing the inflow of forex. Now, we know that we have banked on FDI to bring in some. For 5 years, we are struggling to see them. They're not where to be found.
Professor?
Then the events that are happening, including the recession, have forced, and what has happened on the
Professor,
Professor
Ife.
Sorry?
Professor Ife, I'm so sorry. I just have to cut in here now. I understand the central bank governor is briefing now, so let's listen to him and get to know what he has to say.
Following a second consecutive quarter of contraction in output. The third quarter contraction was, however, milder than the previous quarter. The committee appraised the developments in both the global and domestic economies, as well as the outlook for the rest of the year and the first quarter of 2021. 10 members of the committee were in attendance at this meeting. The global economic developments. Although the global economy witnessed a better than expected recovery in the second quarter of 2020, it, however, continued to be weighed down by the headwinds largely associated with the COVID-19 pandemic and weak crude oil prices. In the advanced economies, the persistence of weak aggregate demand, slow recovery in supply chain networks, and the rebound in COVID-19 infection rates have cast a new wave of uncertainty over their recovery in the short to medium term. In the emerging markets and developing economies, China continues to lead the recovery, recording a stronger than expected growth in the second quarter of 2020. In India, on the other hand, growth continued to be muted as a result of increasing rates of COVID-19 infections and fatalities. In general, this group of economies is set to contract less compared with the advanced economies led by the expected strong recovery in China. Consequently, the International Monetary Fund, IMF, reviewed the forecast for global growth in 2020 to reflect a slower pace of contraction from minus 4.9% to minus 4.4%. Inflation in most advanced economies is expected to remain subdued in the medium term to long term, as aggregate demand remains weak across several economies, reflecting the impact of the pandemic on income. The U.S. economy has, however, maintained a steady pace of job creation, even though infection rates and total fatality continue to rise in that country. The threat of a rebound of the pandemic in several countries has resulted in second and third waves of lockdowns in these countries. This is expected to further dampen aggregate demand and slow the pace of price development. In several emerging markets and developing economies, inflation remained relatively high compared with the advanced economies, owing to the persistence of exchange rate pressures, dwindling capital flows, and weak accretion to reserves, as well as other structural issues. In the financial market, conditions remain relatively stable, buoyed by continued monetary and fiscal stimulus. The huge level of monetary and fiscal injections has, however, increased the likelihood of a global financial crisis post the pandemic, especially when central banks commence normalization of monetary policy. The domestic environment. Data from the National Bureau of Statistics showed that real GDP contracted by minus 3.62% in third quarter of 2020, compared with minus 6.1 and 2.28% in the previous quarter and corresponding period of 2019, respectively, thereby pushing the economy into recession. The oil sector contracted further by minus 13.89% during the third quarter of 2020, from minus 6.63% in the previous quarter, while the non-oil sector contracted by minus 2.51% during the third quarter, compared to minus 6.05% in the preceding quarter. The persisting weak performance was mainly attributed to the lull in economic activities associated with the low price in the oil market, as well as the lingering effects of the coronavirus pandemic. MPC observed the gradual improvement in manufacturing and non-manufacturing purchasing managers' indices, which rose to 50.2 and 47.6 index points respectively in November 2020, compared with 49.4 and 46.8 index points in October 2020. These developments signpost an increase in economic activities driven by growth in new orders, improved supply delivery time, rising production levels, and new export orders. The employment level index components of the manufacturing and non-manufacturing PMIs also improved in November 2020 to 47.3 index points and 46.7 index points respectively, compared with 46.0 index points and 44.2 index points in October 2020. The committee, however, noted the likely downside risk to growth of the recent unrest in the country, warning that this may adversely impact economic recovery in the near term. Committee noted with concern that inflation has been on the rise for the 14th consecutive month, as headline inflation year-on-year moved up to 14.23% in October 2020 from 13.71% in September 2020. This was attributed to the increase in both food and core inflation, which rose to 17.38 and 11.14% in October 2020 from 16.66 and 10.58% in September 2020 respectively. The continued increase in food and core inflation was attributed to the persistence of insecurity across the country, as well as lingering structural deficiencies impacting logistics of moving food items to urban areas such as poor road networks, unstable power supply, and a host of other infrastructural deficiencies. Other factors include the persisting impact of coronavirus-induced supply disruptions, recent hikes in price of energy products, PMS and electricity, and weak crude oil prices. Committee, however, noted that the rise in inflation will likely abate in the medium term as domestic production is expected to recover following the resumption of economic activities post-COVID-19 lockdown. In addition to this, food inflation is expected to moderate as harvest season sets in. Monetary and fiscal policies are also expected to continue their broad-based stimulus support towards full recovery. This will involve fiscal measures to reduce unemployment, provide an enabling environment for private sector investments, and necessary support to the health sector to cushion the impact of the coronavirus pandemic. In addition, the CBN is expected to sustain its various intervention measures to boost consumer spending and support recovery. Committee noted that growth in broad money supply M3 increased marginally to 3.53% in October 2020 from 3.20% in September 2020, reflecting an increase in net foreign assets. It further noted the moderation in contraction in net domestic assets to minus 2.19% from minus 5.05% in the previous period. Aggregate domestic credit, however, grew by 7.61% in October 2020, compared with 7.35% in the previous months, as a result of the bank's policy on loan-to-deposit ratio, supported by the bank's interventions in the various sectors of the economy. Total gross credit by the banking industry stood at 19.54 trillion naira as at the 13th of November 2020, compared with 19.33 trillion naira at the end of August 2020, an increase of 290 billion naira. When compared with 15.567 trillion at the commencement of the LDR policy in May 2019, total gross credit increased by 3.976 trillion naira. These loans were granted mainly to manufacturing, 738 billion naira, general commerce, 874 billion naira, agric and forestry, 301 billion naira, construction, 291 billion, ICT, 231 billion naira, just to mention a few. Committee noted the reduction in interest rates on loans granted by deposit money banks, and as at October 2020, 86.23% of total loans granted to over 1 million customers by deposit money banks were at interest rates considerably below 20%, and this was an improvement from 76.43% as of July 2019. MPC noted the improvement in financial soundness indicators of the deposit money banks in Nigeria, which showed capital adequacy ratio of 15.5%, non-performing loans ratio of 5.73%, and liquidity ratio of 35.6% as at October 2020. As regards non-performing loans, MPC, however, noted that the ratio remained above the prudential benchmark of 5% and urged the bank to sustain its tight prudential regime to bring it below the benchmark. Committee welcomed the improvement in the financial soundness indicators of the other financial institutions in the sector, as indicated by the growth of 582 billion naira or 16.94% year-on-year in aggregate assets to 4.02 trillion as of September 2020. Similarly, aggregate credit grew by 217 billion in the OFI sector, or 12.27% year-on-year to 1.99 trillion naira during the same period. Capital adequacy ratio for the subsector also exceeded the minimum prudential ratio of 10%. The committee recognized the supportive developmental roles of the CBN towards addressing some of the structural issues in the economy. The MPC specifically expressed optimism on the future impact of the disbursements from Agribusiness Small and Medium Enterprise Investment Scheme, the AXMIS, by 92.9 billion naira to 24,702 beneficiaries, Anchor Borrower Program by a sum of 164.9 billion naira to over 954,279 beneficiaries, and COVID-19 Targeted Credit Facility to households and SMEs by 149.2 billion naira to 316,869 beneficiaries. Liquidity conditions in the banking system continue to influence money market rates in the review period. The OBB rate declined progressively as a result of rising liquidity levels in the banking system, while there were no transactions at the uncollateralized interbank call window. Consequently, the monthly weighted average OBB rate declined to 1.88% in October 2020 from 3.5% in September 2020. The committee noted the recent impressive performance recorded in the equities market, particularly the increased patronage by domestic investors, largely driven by low yields in the money market. The all-share index increased by 20.55% to 30,520.69 on October 30, 2020, from 25,327.13 on September 30, 2020. Similarly, market capitalization grew by 20.82% to 15.96 trillion from 13.21 trillion over the same period. This improved performance was largely attributed to positive third quarter corporate earnings as investors moved in to pick up bargain stocks. Committee observed a moderate decline in external reserve position, which stood at $35.18 billion as at November 19, 2020, compared to $35.95 billion as at the end of September 2020, as crude oil prices continue to fluctuate with downward pressure. Our outlook. Overall, medium-term outlook for the global economy is beginning to show a ray of optimism following the discovery of COVID-19 vaccines. In the domestic economy, available data and forecasts for key macroeconomic variables also suggest optimism in output growth during the fourth quarter of 2020 due to the positive outlook for most economic activities. Accordingly, the economy is expected to recover from the recession by the end of 2020, while inflation is projected to moderate by the first quarter of 2021. Committee's considerations. Committee's considerations remain focused around tailwinds imparting upward pressure to domestic prices and key headwinds to output growth. The committee noted that inflation continued to be driven by supply-side disruptions arising from COVID-19 pandemic and other legacy factors. Key amongst these are security challenges in parts of the country, increase in food prices, and the recent hike in pump price of PMS and electricity tariff. MPC therefore emphasized the need to address structural supply-side issues by putting upward pressure on cost of production and unemployment. To address the public health crisis associated with COVID-19 pandemic, committee urged the federal government to make relentless effort to procure a substantial quantity of the COVID-19 vaccines to surmount the public health crisis and pave the way for a broader macroeconomic recovery in the country. Committee noted that the contraction had bottomed out since it moderated significantly from minus 6.1 to minus 3.62% during the third quarter. This was so because both the monetary and fiscal authorities had anticipated the impending recession and had put measures in place for its quick reversion. Some of these measures include the Economic Sustainability Program, by the federal government and other CBN facilities targeted at households, small and medium enterprises, youth empowerment, and reduction in unemployment. It thus urged the federal government to maintain its initiative targeted at reducing employment, particularly amongst the youths, citing the recent NSAS protests and ensuing agitation by hoodlums as potentially disruptive to output growth in Nigeria. As a result, the MPC reiterated its support for the various development finance initiatives of the CBN to stimulate production and reduce unemployment. MPC further encouraged the bank to intensify its efforts by increasing funding to more beneficiaries so as to boost consumer spending and accelerate recovery from recession. On the financial markets, committee considered the improved performance in the equities market as a leading indicator of medium-term macroeconomic recovery. It thus urged the bank to maintain its policies on exchange rate and financial system stability to attract more investments into the equities market. MPC noted that credit to key sectors of the economy increased and encouraged the continued credit support to employment-stimulating sectors to hasten the recovery of output growth and improve employment, particularly amongst the youths. Committee emphasized the need for the CBN to maintain its regulatory surveillance over the banking system to ensure that non-performing loans remain low. MPC noted with pleasure the CBN's engagement with relevant stakeholders, particularly in the private sector, to hasten the recovery of growth. This engagement would involve collaboration towards job creation and provision of credit facilities to stimulate business activities to both corporate and individuals, particularly those who lost their goods and business premises to hoodlums during the recent protest. Committee's decision. At this meeting, the committee focused not only on price stability, but also on the need to speedily take actions to exit the recession. In view of these considerations, the choices before the committee were focused whether on the need to tighten the stance of policy to address rising price levels, recognizing its primary mandate of price stability, to support output recovery, or to allow existing policy initiatives to permeate the economy. Committee noted that although the appropriate response to rising inflationary pressures would be to tighten the stance of policy in order to moderate upward pressure on prices, it nevertheless felt that doing this will exert downward pressure on the recovery of output growth. Committee also felt that tightening would negate the bank's desire to expand credit to the real sector at affordable terms, not only to boost production, but also to increase consumer spending. To the committee, tightening was therefore not the appropriate response at this time. With the economy, whereas MPC felt that government spending and the bank's expansionary stance would be desirable to support recovery and guide the economy out of recession, it felt loosening would trigger excess liquidity and worsen the inflationary pressures. MPC also felt that excess liquidity may impact demand pressures and fuel further depreciation of the currency. With respect to a hold position, committee was of the view that this will be beneficial as it will allow current policy measures to permeate the economy while observing the trend of developments. Committee also felt that the heterodox policies of the bank targeted at various sectors are showing positive results that will further engender growth. On balance, MPC was of the view that although all three options offer some benefits to the economy, The hold option was desirable at this meeting. Based on these factors, members voted in line with the most pressing need towards reversing the recession and achieving medium-term macroeconomic stability. In view of the foregoing, committee decided by a unanimous vote to retain all parameters. In summary, MPC voted 1. To retain MPR at 11.5%, 2. Retain a symmetric corridor of minus 100 and plus 100 and minus 700 basis points around the MPR, and 3. Retain CRR at 27.5%, and 4. Retain the liquidity ratio at 30%. I thank you for your attention.
Thank you, Governor. And that is the communique of the 276th meeting of the Monetary Policy Committee of the Central Bank of Nigeria, presented by the Governor of the CBN. Thank you, sir. Now we'll take some questions. Some of the correspondents are here, and some sent in their questions online. So we'll start with you. Okay. Okay. That's your name.
Yeah. Good afternoon, Governor, and good afternoon. I am Nancy Naji, Moneyline with Nancy on AIT. I have two questions. Governor, taking you up on some of the things you said in the communique, that 149 billion naira has been disbursed to over 316,000 beneficiaries under the TCF, Targeted Credit Facility, and under AXMIS, you've disbursed over 92 billion naira. I would like to know, are there other steps, are there other measures? Because some people are yet to get alerts, or some people are yet to be credited. Are there other steps to credit other people? Because we know it's a recessionary time right now. People need to be stimulated. Demand needs to be stimulated. That's one. The second question is, it's no longer news we're in a recession. That was according to the National Bureau of Statistics just on Saturday. Some of the contributory measures could be oil price and COVID-19. What specific steps is the monetary authority going to take to make us exit this recession quickly? Because the finance minister said it's going to be short-lived. Are there specific steps? Thank you, sir.
Good afternoon, sir. My name is Lara Folanya and I work with TVC News. I'd like to know, as the parallel market rates have started climbing up again, I'd like to know what your comments are on this development. That's number one. Then with the inflation rate now at about 14.23%, I'd like to know what measures you're putting in place to address this growth we are seeing in inflation. Thank you.
Thank you. Governor, I have also some questions from some of the correspondents. They sent in their questions. This one is from Ndoka Chiejina of the Nation newspaper. And his question is, in May 2020, you had warned about a looming recession if the country did not do the needful to enhance our production and reduce the high rate of unemployment. Now that the country has entered into another recession, what is the CBN doing to facilitate the country's early exit from the recession? And the second one is from Obinna Chima of This Day newspaper. And the question is, given the youth restiveness we saw in the country during the third quarter of 2020, what is the CBN doing to respond and help youths in Nigeria? Thank you, sir.
Okay, well, thank you. And Nancy AIT talked about the fact that so far we've disbursed 149 on the targeted credit facility meant for households and and the SMEs, and about 92 billion to AXMEs, whether there are more opportunities for those who have not accessed this kind of funding. Like you all recall, in March, at the outset of COVID-19, the CBN came out very, very quickly and put on the table a couple of initiatives that we believe are meant to help alleviate the pain of COVID-19 on our people. First, we talked about how the banks should restructure their facilities, how interest rates should come lower, particularly for CBN interventions, and how repayments could be spread for those who are owing banks so they have some more respite given that their cash flows have been badly affected. On another hand, we also proposed that for targeted credit facilities to households and small-scale businesses that are adversely impacted by COVID-19, that we're going to put on the table 50 billion naira for them. These are unsecured facilities meant for people who we feel are impacted and they just needed some little money either to start business or conduct some kind of consumption so as to help them live their lives during the period of pandemic. We also put on the table 100 billion naira for healthcare industry, for pharmaceuticals and hospitals, for their upgrade or building of new ones, and made available also a facility of 1 trillion naira to corporates who are willing to expand either in the agriculture or manufacturing sector. Let me say that to date, we have seen tremendous response on these initiatives. And I must also say that these initiatives, together with those that have come from fiscal, have been responsible for the somewhat moderated impact of COVID-19 on the lives of our people.
Well, that was the Central Bank Governor Godwin Emefiele answering questions after briefing on the outcome of the Monetary Policy Committee meeting, the last one for the year, and they decided to leave all the monetary policy parameters unchanged. MPR left at 11.5%, CRR 27.5%, symmetric corridor plus 100, minus 700 basis points around the MPR, and liquidity ratio at 30%. Well, I still have with me Dr. Muda Yusuf, and of course in our Abuja studio, Professor Ken Ife. Professor, I will start with you now. Your expectation was for the Monetary Policy Committee to tinker again with the MPR, but that didn't happen. But having listened to the governor talk about the variables that were considered, do you think they are justified leaving all these parameters unchanged?
Yeah, I personally wanted a marginal decrease in the MPR rate to send a signal to the commercial banks to continue to bring down the rates. Because in the end of the day, the lower the interest rates, the better opportunity that we have to boost consumption. I want to explain something to you. It is true that there is liquidity, excess liquidity at the private sector end. It's also true that the corporate community are raising corporate bonds, commercial papers. They're raising money at interest rates like 5%, 6%. Yeah, that's the corporate sector. The MSME sector are over 90% of the population. They account for over 49% of our GDP. They're not having access to this opportunity that we're having. And household consumption, remember when you disaggregate GDP, you can look at the output side of GDP, where you look at agriculture has flipped now from 27 to now 30%. And then you have services dropping down to 47 from 54. And then industry remaining the same as 21. But look at the consumption side of GDP. 84% of consumption is household consumption. Government is only 5.7% consumption. So it's one thing to improve output, is the other one to have the power, the purchasing power to purchase the thing that you produced. So that's why household consumption is very, very important. If you have a collapse in aggregate demand, you're in trouble. You haven't moved anywhere. If you put so much money to the private sector to produce, and you suddenly produce, you have a spike in output, but there's nobody to buy the thing, you will go down the following month. So that's why you're going to have to approach those with the balance. So the lower the rate is, the more even the consumers can borrow as well to boost aggregate demand. So that's one point. Then the other point, of course, is that inflation. Yes, I have listened to the argument that a lot of the supply factors, cost factors are inevitable and evident in terms of how petrol has and the cost of power and all of that have actually shot up input costs. Transportation is about 20% of input costs, and power is about 30%. The two alone is about 50%. And you wonder how is Nigeria still managing to be competitive under this cost profile. But look at the culprit is food. We know that, yes, there is conflict in all the 5, 6 geopolitical zones, different types of conflict, banditry, terrorism, clash of major food chain in the center, and then also all that stuff happening in the south. But look at border closure. I heavily supported border closure because it was important that we observe the ECOWAS protocols that relate to border integrity. You know, we can't have our economy drop their guard and have massive dumping of goods here. Some of them are substandard, and then we are losing revenue from custom revenue. And in the period, we saw a spike in revenue of $5 billion or more a day. So by having tested all that, we don't want small arms coming through. We've seen lots of drugs coming into Nigeria. We can't find in the streets where they are consuming them. They are mainly consuming them in the theaters of war. So we've heard what the security community are telling us. You have to do something. So all that experiment on border closure had some results, opened our eyes, but it can't go on forever. So we are now saying it's now time to gradually phase open the borders, because there's a symbiotic relationship between Nigeria and the landlocked Francophone neighbors in Niger, in Chad, in Mali, because there's a symbiotic business going on with them. They import our food excessively because our currency has devalued from 1 naira buying 3 CFA to 1 naira buying 1.4 CFA. That's almost 55% reduction. So for them, even though the adverse weather condition means they can't grow more food, they are making more business in importing our grains, drying them up, and bringing them 6 months later and selling them at 50% of the price. There is also a big impact on transportation on food. One, 100,000 naira is the cost of soya beans per ton in Katsina. But by the time it travels down to Lagos or Port Harcourt, it's 75,000 naira per ton to transport it down. And that's transportation, which is now taking a hit from the cost of fuel and all of that. So we need to understand that food. Okay, look at the figures. Core inflation has always been around single digit for more than 3 years, just crossed over to 10 and now 11%. And the distance between the core inflation, which excludes food, sub-basket, and then the sub-basket is 17.5. The distance is 6%. Very, very wide distance. And then, of course, the headline sits in the middle of them at 14.23%. Even the urban and the rural inflation, they're all over. And the first time now, urban has gone above the CPI, composite headline inflation. For the first time, I've seen it go just over, which means that the price rise is more intense in the urban area. So having said that, we need to see the food dimension. We need to also look at the border issue to see, even if you say, okay, we don't want, if you decide that 2 products are causing problem, then ban the 2 products from coming in through the border. If you say rice is a problem, let's stop having rice through the border. If you want rice into our country, import it and bring it through the seaport. Get it in through the air, where we have enough resources to man and inspect. But the other things that can happen, let them go through. Once we are moving our grains up there, we're also bringing things. Northeast is where we grow our onions and potato. But now look at the price of onions. It's moved 400% increase in price. And of course, there's flood affecting yield. And yes, but we needed to even have more come from from our neighbors on the top. So we need to look at agriculture on the way in which it's affecting inflation. And also remember that is the story about liquidity in the private sector is not all private sectors. The informal community, informal sector are just not having a look in this excess liquidity. And the MSMEs are not having enough of it to actually make sure that we can push cottage industry to process and reduce these 30 to 70% post-harvest losses that we are having, which is a value addition is very, very important for us to actually make sure we seal this deal and bring down inflation to a level that is sustainable.
Okay, Dr. Yusuf, Professor Ife is not happy that they didn't reduce, at least he was expecting some kind of reduction again on the MPR. I don't know, did that come to you as a surprise that nothing happened? I know that your major concern is the fact that the central bank governor did not talk about the fact that there's issue in the foreign exchange market. Yes, we're talking about inflation, which is, of course, part of what we have. The fuel price, he noted that, the hike in fuel price that is driving inflation. And part of what is causing this hike in fuel price, and then now government, of course, is talking about deregulation. Now, you can say deregulation in quotes, because I really don't know if that is a proper deregulation, because they say when oil price goes up in the global market, then they have to hike the price. And when they hike the price, of course, there will be inflation. And all of these things is centered in the foreign exchange market.
Yes, thank you very much. First, let me say that I'm concerned that the issue of foreign exchange doesn't seem to be high enough on the agenda of the MPC. Because if we are dealing with the economy and we want to solve the prevailing problems in this economy, as far as investors are concerned today, apart from the structural problems, which you cannot fix immediately, the foreign exchange issue is the biggest problem that we are facing. And in all of the communique, there is no adequate reference, at least to give comfort to investors that we acknowledge the challenges and this is what we are doing about it. Because a lot of investors are in the dark. There is so much uncertainty. And one thing that investors don't like, and something that also aggravates risk of investment, is uncertainty. You are not sure exactly what is happening. You are not, the model is not even so clear. So I feel that at least the MPC should be talking more about what is doing about the foreign exchange situation. Of course, we all know that there is scarcity. We know that we have challenges with the oil price, oil output, and the impact on the foreign reserves. That we all know. But what is the framework for managing whatever we have? What is the framework for even incentivizing suppliers? Because oil is not the only source of supply. Diaspora remittances for several years was over 20 billion US dollars. You could also have foreign direct investment. Now those who are in the non-oil export, they are complaining a lot now about foreign exchange policy. That's another challenge through some foreign exchange can come in. What are we doing to harness other sources of supply? We need a clear strategy around that. So that is one issue I think we need to worry about. And that is something I expect.
Perhaps they don't have that clear strategy. What sort of strategy for you, if you are to advise, to be the central bank's advisor now, on the strategy to take to actually clear that situation in the foreign exchange market, what would be your advice?
You see, even in the economic sustainability plan, one of the issues or one of the recommendations in that plan is that we should have a market-driven exchange rate or a unified rate at best.
And that is not happening.
That is not happening. Because I believe that if we begin to move in that direction, it could go a long way in solving some of these problems. Now, I tell you, recently there was an instruction or a policy around the NXP. NXP is the non-oil export process form that they fail. The CBN recently, charged the shipping companies and all of that people are not filling the NXP. They were exporting through the back door. And why? Because compliance is also a function of the credibility of policy. If policy is not very credible, compliance will be an issue. Now you are an exporter, you export, you get your export proceeds, and you are being compared to exchange at 380 or 383 naira to the dollar. How many exporters will want to surrender the export like that? And if you want to bring in money either as FDI, as diaspora remittances, you are getting rates of around 386. When the market rate is now going to 480. All of these things are creating problems on the supply side. The emphasis of foreign exchange management today is too heavy on the demand side. We should be doing something around the supply side. How do we encourage legitimate inflows? Because what is happening now is that a lot of transactions are going underground. A lot of transactions are now going to the informal sector, going to all sorts of funny windows. But if you have a rate that is transparent, that is sustainable, that is market-driven, all of these things will come to the table. Right. And we have a situation where we have a normalized foreign exchange market. This is what I think should happen.
All right, Dr. Muda, we really don't have more time. We have to wrap up this conversation. Now, a quick one, Professor Ife, just a very quick one. We are in a recession now. Yes, the government is very optimistic. The government is very optimistic that come first quarter of next year, we're getting out of this recession. However, there has to be a synergy between the monetary policy and the fiscal authorities. What kind of synergy would you want to see? A quick one, please.
Yeah, I think I support the central bank for playing safe. Because when you have so many measures coming out, you want to play safe just because you're already in a recession. So I know that in the next meeting, they will be more ready to take risk. But fiscal side of it is very important. Of course, we've all saying that you can even see some response from fiscal in terms of treasury bill yield dropping significantly and sending a signal to the banking community, let's go this way. But also, there are more things to be done. The narrative must change on our debt and service and start bringing in the assets. Let's get more look at our assets to boost liquidity. Because if we do more privatization, more concessioning, more commercialization, and then reduce our equity participation, government equity participation, to bring in more investment, in that way we're boosting liquidity, because liquidity is the big challenge that we are having. The challenge is not headroom in borrowing. Yeah, we have the headroom, but it is in debt service, which is over 50% and going to 70%. That's what brings the fear of fiscal stress. So we need to do more of that. And then, of course, we have the government looking at national savings schemes, which could offer 3 to 5 years index-linked, inflation index-linked interest, and then mop up liquidity for a longer term. And then that way, we will begin to have more people come in the formal sector. So all of these are in the works, but it is the way to use fiscal to meet, to align with monetary policy. and bring that convergence. Of course, we need more quantitative intervention from the fiscal side of it. And I'm glad that they're doing it, because you look at the 2020 Finance Act, 2019 Finance Act, they're all steering in the right direction. It's just a question of time.
Thank you very much, Professor Ken Ife, for sharing your time and sparing us your time. Thank you very much, Dr. Muda Yusuf.
Thank you.
You're always there for us. Thank you. I appreciate you both. And that's it on the MPC Decision Day. I'm Chimeze Obi Iwago.